I am in Germany now, but I hope this is appreciated by some. More importantly, at about the same time that the Federal Reserve was actually created was the last time the Cubs actually won the World Series in the United States, and then it just happened last year. So I consider those two things important, and I think the best way to forecast central banks is to monitor what the Cubs are doing. I think that's your best bet there. Over the last since really the Great Depression was the first major time that we saw really interesting research into central banks. And we can look back at that and say that luminaries like Milton Friedman won their Nobel Prizes in part for understanding central bank activities during the Great Depression. And it wasn't that they were the only influence, but it was very, very important. I believe personally that there will be Nobel laureates in economics that arise from the current situation as we look back and try to understand what is going on now. And there will be so many things to understand in terms of central bank balance sheet growth and contraction. In addition, things like target 2 balances here very close to home. And all of these things will be really, there's no precedent for. And the unique elements of those are not fully yet understood in the marketplace. However, we can get some perspective, and that's what I'll try to focus on today. First, legal disclaimers. I'm an American, you know, this is what you get. I think it's supposed to be 20 pages, but I condensed it. You got the abridged version. First, I wanted to look at fixed income returns going back until the middle, roughly, of the last century. Middle of the last century, excuse me, is interesting because that was simultaneously the beginning of the baby boom and the Cold War. And we had periods of interesting growth, strong growth, because of that demographic dividend that occurred, and as well because of the relative stability that allowed resource allocation to be done in a more effective way and therefore contribute to production or productivity over the course of the last half of the last century. Now, what's interesting as you look at this is that the returns, I've put them all on the same scale. These are various regimes that I've worked with now really for, I guess I started kind of showing these regimes back in the right around 2000, and it still remains the case that these regimes last something like 17, 18 years. I don't know why. That's not that I'm forecasting that or anything. It just seems to be the case. And if you look back to the period from the early 50s on into 1965, what I'd noticed there is the real return is 5.4%. That was an environment where interest rates were relatively stable. The yield of the 5-year started at about 3%. It did go as high as 5%, but ended up that period at about 4%. So it was a very, very stable environment that had a coupon that was not zero. It was actually somewhat greater than it is today, and that provided a backdrop for very strong real returns. However, if we look at the other regimes, we see that 2 of them actually did well in terms of real returns and 2 didn't. The most important one of those is on the bottom left. And I'll get to that, however, by looking through the period of the late 60s and the 80s. And obviously that was when the the monetization of the oil crisis actually led to inflation. Yields went from 4% on the 5-year up to 16% on the 5-year. Yet at that period of time, the real return was only about 2.5%. No surprise, capital loss overwhelmed the increasing coupon that you got over that period of time. The one period that really stands out as unique is the period after 1980. So that regime on the bottom left there, coming into basically close to the end of the century. And that was when those yields started at 16%. The yields dropped down to 6% over that period of time. So any investor was able to garner a nice coupon for most of that period of time. In addition, a relatively speaking, nice capital gain. And again, the real return there was quite significant, 5.4%, 5.3%. The final period that we look at is really when we begin to think about the period of manipulation of interest rates and asset prices. Not in the very, very beginning, but clearly after 2008. And in that environment, the yields dropped from 6% all the way down to 1%. Capital gain, yes. Real return, not too exciting, 2.6%. What we're looking at in that environment is, despite, well, I'll come to that in the next slide, but the question over this period of time is that nobody knows what the market price actually is. Nobody knows what the natural rate of interest is that the market would ultimately find or equilibrate to if it weren't for central bank behavior. Now we are starting another regime, maybe, but at this point looking forward, where we don't have a high coupon and we don't have stable or falling interest rates that are the backdrops of solid fixed income returns. So not surprising to anybody here, the environment that we have going forward, really pretty much regardless of what central banks do, is one where fixed income assets are not necessarily the best thing to seek out in terms of a large allocation to a portfolio, but it doesn't mean that other things are a free ride, in the sense that this central bank behavior has created a very significant period of resource misallocation. Let's look at what was going on in the equity markets. And I'm just showing US here, and I've looked globally at it as well, and the picture is about the same. So I wouldn't make any different conclusions. This is just very nice in that I have nice, complete data that includes credit in the fixed income space and a relatively broad equity market. So it's not influenced by anything unique other than the fact that it is the US, but it's still a statement. Any statement I make can be pretty much made on a global basis. In the stable real rate environment, on the top left, that first regime, again, these are the same regimes. And if you look at it, the scale here for the fixed income was 0 to 700. The wealth index is all contained within that scale for fixed income. The scale, however, for, oops, back to legal disclaimers, the scale for the S&P 500 goes up to 2,500. So the scale is much larger there, about 3 to 4 times larger when we're looking at these returns. The first period of stable rates is one where asset prices actually could perform well, and the real return to equities from 1950 on into the mid-60s was about 14.2%. The only other period, just with fixed income, where we had those types of returns were the period from 1981 up through the end of the century, or the end of the decade of the 90s, and that was also about a 14.5% return. So a stable rate environment or a declining interest rate environment was quite good for asset prices. On the top right, a rising interest rate environment over the course of the monetization of the oil shock was a period where real returns were actually negative. And again, let's take a look at this most recent regime where we have falling interest rates. It just doesn't seem too exciting. I mean, people think of the US as well as some other markets as having tremendous rallies over this period of time. It's really not the most exciting picture that's painted over the course of the last 50 to 60 years. Granted, this is not a log scale. I understand that it's not a log scale, but I wanted to give you a sense from this perspective rather than just a log scale at this. But this is the perspective that we have. Now, what I want to do, most importantly, from that characterization or that background perspective, is now focus on the environment since 2008. The environment since central banks have really been aggressive in their ownership of capital markets, in effect. They are the economic player. They're the economic player driving capital markets throughout the developed world and through various monetary policies, currency pegs, etc., even beyond that. So if we think about what central banks' policies are, it is defined by the central banks themselves as a portfolio balance effect. As a portfolio balance effect, they're basically looking to make investors, or to push investors out of low-risk assets into higher-risk assets, simultaneously boost those asset prices to give a sense of wealth that takes future production, brings it back to now, and tries to kickstart the economy. And they've been wildly successful in one dimension. They have really done a good job of making sure since 2008, fixed income investments, in this instance the Barclays aggregate in the US, provided no profit for investors. So they accomplished making sure that investors didn't make any money if they shied away from risky assets. By the same token, they were also successful in driving investors into risky assets and generating very profitable environment for investing in those assets. Now, the US is relatively unique in the sense that a portfolio balance effect drives investors to the riskiest assets or riskier assets. After the global financial crisis, there's been a behavioral shift, a very important behavioral shift, where investors really do not want to take downside risk or tail risk. Over my 30-year career, I've often been asked about how I manage downside tail risk. However, I will say right now that there's not a single meeting that I go into, whether it's with an existing client or a prospect, where I'm not asked how I manage downside risk. And that's a very, 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 very important thing to think about as investors move into various allocations and make various investments today. Now, they were successful at making less risky assets not profitable and risky assets profitable. They were successful in pushing assets that direction, or pushing capital into those riskier assets, focusing more and more on the US because it was the one market that had a lower probability of a downside tail risk in the mind of the market. So while investors were pushed into risky assets, they really tried to focus on the least risky of the risky. Where central banks failed dramatically was in any form or fashion creating real growth. Real growth. In the US, real growth annualized over this period of time was 1.7%. 1.7%. In Europe, the MSCI for the Eurozone had a lower return than what you see here for the US, again, consistent into risky assets, but those without downside tail risk, pushing people to the US, investors to the US. But if you look at Europe, the picture is not any different. The growth, annualized real growth rate was 0.4%. 0.4%. This is what would be known as a dismal failure. A dismal failure on the part of central banks. Yes, they were able to invoke a portfolio balance effect, and yes, they provided trust and liquidity into the market during the global financial crisis, and then again here in 2011, 2012. However, they weren't able to do anything more than that. Yet at the same time, they kept expanding their balance sheets further and further. So what you have is a tremendous amount of manipulation of asset prices over this period of time. However, they've done it without any growth. And a better way of saying that, and a more valuable way of saying that, is that that manipulation of asset prices and interest rates has created a misallocation of resources over this period of time without anything to show for it. And it's worse than that. Not only do we not have anything to show for it in terms of realized real growth, we also have a period where resources have been misallocated, and in the intermediate term, we as a society globally have to unwind that resource misallocation. Generally speaking, in our team, we believe that kind of in total, the real GDP growth of, whether it's the US or Europe, more in the US, will probably be hindered in aggregate by about 10 to 15% over the course of many years due to this resource misallocation. This is not going to unwind itself overnight. This is going to take 10 to 20 years to unwind. It will take a long period of time, and central banks will move slowly. Will move slowly in this environment. The reason they'll move slowly is that central banks have ceded control of monetary policy in part to the market. I began Fed watching, I didn't, Fed watching kind of, back in the 80s. And back then, and all the way up through today, central banks have a very important constraint in the back of their minds. They never want to surprise the market. Back then, they'd get on the horn with the primary dealer community, probe what expectations were from the primary dealer community to determine what, in fact, they could do. Now, it's quite nice and quite easy to look at any number of measures of probability of what the market already has priced in. If central banks observe that the probability is sufficiently high, they will change rates. If they do not believe it's sufficiently high, they will not change rates. And that's an important thing to remember, and that is a governor on the ability of central banks to actually modify monetary policy too much going forward, or too quickly going forward. Final thing in terms of just a perspective on the manipulation of interest rates, we look back over this longer period of time from 1990 to present. These are real LIBOR rates in effect around the world, 3-month LIBOR rates. And we can see it's a number of countries here, and we can see, generally speaking, those real rates are positive. Japan is the one entity that drifted around zero and below zero. Since, however, the global financial crisis, the real LIBOR rates for these various countries have been zero or negative. Zero or negative. What market sets the real short-term rate of interest below zero? What market actually would price the time value of money negatively? Only a market dominated by a single player manipulating interest rates and asset prices. And that's what we've had. And now that we've had it for about 10 years, we shouldn't expect it to be unwound quickly. We should expect it ultimately to be a drag or a constraint on real growth over the intermediate term. And I'll say for now, intermediate term, roughly about 10 years. Longer term, I'm actually an optimist, but this is a difficult environment that we have to get through. It's one of the reasons why investors often talk about secular stagnation, or I shouldn't say investors, academics often talk about secular stagnation. Couple things to think about that. Usually when they talk about it, all the research is focused on the US. Second thing is, it is a comment that is often interpreted to mean over the long term, as opposed to an intermediate term phenomenon. And some actually believe it is longer term. Robert Gordon, the Luddite of the current century, is one of those individuals who believes all that we've been able to discover through technological advance and innovation has been done, the low-hanging fruit has been picked, and from now on out, we just don't have that opportunity. I don't see that as actually being the case. I think that's a rather pessimistic way to take a look at things. I've got the ECB balance sheet, assets here and liabilities. All I want to comment on very briefly is on the asset side, the balance sheet growth here has been quite significant, but it is focusing on securities to Euro area residents, of which the asset purchase program, I put PSPP, but I should have said asset purchase program, is really what's behind that. The CBPP 1, 2, 3, the asset-backed security purchasing program, as well as the public sector purchasing program, all behind that and boosting the balance sheet. Similarly, the yellow there is the TLTROs and the LTROs kind of coming up and falling off and now pretty stable. That was a portion of it, but it hasn't contributed here more recently. That's interesting, but what's more interesting is that a lot of that is simply on the liability side falling into reserves. And it is why ultimately the ECB's measure of net lending, the ECB's measure of liquidity, generally speaking, are relatively low as they think about credit provision. And that environment is one where, again, we don't see the backdrop of growth support that typically we would see if a central bank were to do this and try to jumpstart economic activity. final thing, I guess, in terms of that is I would say that target 2 balances are quite controversial. I don't have the luxury of not having an opinion because I have the need to make investment decisions. I do have a strong opinion about them. The biggest observation I can make is that they're problematic when there are large ultimate obligations. In effect, the Bundesbank has an asset of about $750 billion. That asset is a claim on predominantly the Bank of Italy and the Bank of Spain. It's really not a good idea to separate the lender of last resort function and the monetary function. It's a difficult thing to do, but that is quite problematic. In the United States, when the U.S. Created the Federal Reserve, with the Federal Reserve, the regional Federal Reserve banks, once a year, those regional Federal Reserve branches, in effect, transfer assets among each other to effectively zero out what would be called target 2 balances here in Europe. They're zeroed out every year. So we don't have a buildup of assets and liabilities. We don't have a buildup of exposure that exists there. That's a difficult environment, and it's one of the things that makes me feel somewhat confident that even if Italy, in my mind, the most important geopolitical entity going on today, actually does ultimately vote in the 5-star movement, and they do actually seek a referendum with a population that, generally speaking, leans toward exit from the Eurozone, that the cost of doing that for the Eurozone, of reconciling or creating a legal backdrop, a contractual backdrop to resolve those target 2 balances is a very, very powerful motivation for making sure that the Eurozone stays together. And I think that is something that, at this point, unlike back in 2011 when we were first looking at it, people didn't really realize, and the ECB didn't even report anything on target 2 balances because they were zeroed out at the ECB level. University of Osnabrück began pulling together the data from trade statistics, National Central Bank data, and now the ECB actually provides it. They've actually realized that it's something that is valuable to keep track of. That environment, again, means that there's a lot going on behind the scenes, and there's a lot that we don't understand. And there's a lot that we won't understand until well after the fact. The one most important takeaway here in terms of this discussion is this graph right here. I have been doing fundamental valuation of equity markets, sectors, bond markets, credit categories, points on the curve, currencies, and this includes about 30 different currencies when we look at this. And what we're looking at is the discrepancies, the prices, and fundamental values. Fundamental value is not PE. PE is a cheap proxy for what value actually is. Value is the present value of future cash flows. That's the way we think of value. Now, if this were value and this were price across, in this instance, we kind of keep track of about 125 different markets around the world. But if every price were exactly at fundamental value, that blue line, which is our opportunity set, would be at 0. It would be down at the very bottom, meaning that there would be no incentive to take any active risk in the portfolio. At that point, it's non-compensated risk, or alternatively, if we were to take risk, we'd be leveraging up tiny opportunities to make it look like we're actually doing something important. The reality is, if that were at 0, all of the values and prices would be the same, and there wouldn't be any opportunity for active position taking. However, as prices begin to rise above fundamental values in some cases and below fundamental values in other cases, we begin to see opportunity. And while this is a simplification of what we're really looking at, this is probably best thought of as the standard deviation of all those price-value discrepancies, the breadth of all those price-value discrepancies. And if that blue line is high, it means that there is a significant opportunity to actually take active risk in a portfolio. However, what we see is that looking back through time, so 2008, you'll see the opportunity set jump quite significantly. Prior to that, it varied around some lower level. You can see the dot-com bubble growing out in the late 90s and bursting very quickly between 2000 and 2002. That was the major variation. Interesting, the global financial crisis began at that low point at 2008. Prices were priced relatively fairly, and the global financial crisis blew them away from fundamental values. Now, I believe that the market will always remain sufficiently inefficient to be efficient. I know in another language that's kind of difficult. The market will always remain sufficiently inefficient to attract capital, endeavoring to allocate resources to take advantage of that and thereby push it back toward fundamental values. That, in some sense, is an equilibrium concept of the market staying appropriately inefficient or sufficiently inefficient over time. And for that reason, that level that you see from 1990 up through about 2008 represents, for me, what is an appropriate level of inefficiency. Prices, on average, deviate from fundamental values. Sometimes the deviations are larger, sometimes they're smaller, but that is it's by no stretch of the imagination, well, it could be considered an equilibrium. It is, however, an appropriate level. Now, the global financial crisis hits, that opportunity set goes up, and prices stay away from fundamental values. They now vary around a level that is much, much higher. That's central banks. If central banks are controlling interest rates, equivalently asset prices, what they are doing is preventing the market from equilibrating. They're preventing the market from finding what would naturally be the interest rate if the market were functioning competitively. However, the explicit purpose of a portfolio balance effect is to push the market away from that. Make risky assets unattractive, low-risk assets unattractive and risky assets attractive. And ever since then, it has been a difficult environment for fundamental investors. A previous speaker talked a little bit about smart beta. One of the interesting ones is if you look back at the Fama-French three-factor approach and look at the value factor out there, you can see that the value factor portfolio did really well up to 2008 and has done nothing but underperform since then. Prices can't move back toward fundamental value. They're effectively precluded from moving back toward fundamental value by central bank activity. Where we stand today is at the cusp of the first logs being removed from the central bank log jam that is preventing asset prices to converge on their fundamental values. The first steps of that, and from our perspective, we feel that we're at the first steps of actually beginning to see that opportunity set drop down, not all the way yet to what we'd seen prior to 2008, but move back toward that. In that environment, we believe there will be a fundamental backdrop or support or tailwind for fundamental investing because now asset prices will begin to migrate toward fundamental values. That's the most important thing to take away from what central banks are doing in the markets right now, how they're influencing asset prices, measured in aggregate over about 125 different market sectors, asset classes, currencies, and what we see probably occurring as we go forward. Finally, I'm going to make one quick comment, and I'll be happy to talk about it later at the reception. Right now, from our perspective, downside tail risk is the most highly compensated risk that we can find. It's more highly compensated than we've ever seen over the last 20 years or so. Why is that the case? People don't like to buy insurance when nothing's going on. Unfortunately, insurance buying is a lot like investing. Everybody's chasing the last best thing. So after a few houses burn down in the wildfires, people jump out and buy insurance. In this environment, they're doing that, buying insurance. They're bidding up the reward for taking downside tail risk, and no investors are willing to sell that insurance. Like I said in the beginning, every single prospect or client I have asked me what I'm doing to make sure their portfolio will not experience a downside move through my portfolio. That's what's known as they're expecting every single one of their managers to either be so brilliant as to step out of the market every time there's a down move, just before it that would be, or alternatively to buy insurance. And buying insurance, unfortunately, is one of the things everybody's doing because clients are willing to pay a lot for that. They're willing to accept lower returns. So finally, logjam's breaking. That logjam is breaking as central banks' influence on asset prices is just now beginning to diminish. There will be a drag on growth. We already have the misallocation of resources. We shouldn't expect growth to be high going forward. Longer term, it's been 3.5% real for the last 7 decades. We believe for the rest of this century, basically, it'll be about 3.5% again. The source, however, will be different from the general developed markets that we look at. Right now, the fundamental opportunities are high. The best way to engage in that is in markets where there's downside risk. We particularly like things like Greece and Italy and Spain, a lot of the places people fear to tread. And finally, I guess, in some sense, the event risk is like playing with fire, but it's where the opportunities really are. And that's why we're positioning that way. And central banks have contributed to that by maintaining low interest rates, low volatility that leads investors to leverage into momentum areas. And that's going to be a difficult environment as we go forward, but one you can position around. With that, thanks, and I'm happy to take 5 minutes of questions, I guess, before we break for reception.
Right, thank you very much.
Thank you. Thanks.
Hi, thank you very much. I already have some questions on the iPad. Ich würde aber zunächst mal in die Runde schauen. Haben wir ein Handzeichen? Gibt es von Ihrer Seite Fragen, die Sie stellen möchten?
I'll talk about Trump.
Ja. Dann starten wir mit der ersten Frage, die übers iPad kommt. Brian, how are central banks going to deal with cryptocurrencies? What's your opinion on that?
Goodness. Oh, I absolutely love this. First, cryptocurrencies are not what's important. What's important is what's behind that, and that's called blockchain. Often people say Bitcoin when they mean blockchain. Will absolutely alter our industry. We're probably the most vulnerable to blockchain, forget Bitcoin for now, blockchain altering our industry. The internet is about the transfer of information. Blockchain is about the documented ownership and transfer of property between two entities that do not know or trust each other through a system that they can't trust. It's astoundingly brilliant. It's astoundingly brilliant. Nobody really knows who came up with it. There is a name that is associated with it. Most people think it's a large consortium of people, including John Nash, for example, who developed this. But because of that, what blockchain does is effectively eliminate intermediaries. Eliminates intermediaries. That puts a powerful focus on fintech. It means that generally speaking, the type of wire system that we have, where there's 3-day settlement, 3 days under a blockchain structure is astronomically long. Generally speaking, you can be about 99.9999999% sure that after 10 minutes, it's a valid transaction. And after that, it just keeps getting more and more valid with each day, year that passes beyond it. You can't do anything like that with a credit card. It's going to change everything. Central banks will take advantage of that through cryptocurrencies because that allows them to understand property rights in the sense of who owns it. They don't know who the entity is, but they can track in effect, a code representing that entity. So if there's any concentration, it becomes very difficult. There is absolutely no way you can counterfeit it. And that's a powerful thing. And we see central banks moving toward that aggressively. first steps of that are to eliminate large denomination bills. We're seeing that all over the place. As they bring those down, they'll probably migrate, as they're all researching the cryptocurrency realm, to those currencies as well. Absolutely fascinating. I think it's one of the greatest innovations that has hit society in a long, long time.
Thank you, Brian. Next question is, as an expert, what would have been the wisest strategy since 2008 for central banks?
Well, the answer to that is both cultural and philosophical. As an American, generally speaking, our culture is fiercely independent. And it's often very, very obtuse for anybody outside our culture to understand how that leads to various behaviors, such as Trump and many other things. And that, however, is not necessarily what is the case with all cultures. Many cultures are much more collective. In fact, compared to the US, they all are much more collective. And a societal move, such as central bank activity, to step in and save the system from actually collapsing, is a good idea. I don't think Americans would disagree with that. However, once that trust is back in the system, we would generally feel enough's enough, get out and leave us alone. And in that sense, whether they did the right thing or what they should have done is really dependent on the culture that you come from. At the end, they needed to step in. They are the lender of last resort. They are the provider of trust. You can argue about whether or not they should be. That's cultural. They are. And if they are, they can't pull the rug out from underneath everybody when that's how businesses were built. So they did exactly the right thing. Now, as an economist, I have trained in both Keynesian and in monetary frameworks. I have also taught Austrian economic theory. I'm an Austrian. And because I'm an Austrian, I believe that they went on way too long. It's why I talk about resource misallocation. That's what Austrians tend to think about. Obviously, brilliant people can disagree on this. Nobel laureates disagree, right? They fight tooth and nail over this type of thing. They can fight tooth and nail academically and have great little conversations and be on the news. They don't have to bet their money on it. So I take a step back and say, I have to believe what I think is actually right from a capital market perspective, as opposed to from a capital perspective. Now, if my clients were asking me to manage ESG, that's one thing. My clients happen not to ask me to manage that. So I have an unconstrained framework. My job is not to be their utility function. My job is to generate wealth for them. And the best way to do that in terms of what central banks should do is to get out of the game and let markets price efficiently, because that is the best thing for long-term real growth, even if the downside is relatively difficult to sustain. But again, culturally different.
Ich schaue nochmal in die Runde. Trauen Sie sich? Geben Sie einen Arm. Riti? Next question is for you.
Yeah, when I go into culture and things like that, philosophy, I'm in deep, deep trouble.
So maybe speaking a little bit about culture, I'm wondering about your the price of portfolio insurance in a sort of a Trumpian world. Is the price of that going up?
That's an interesting question. I don't think so.
Is that misallocation? Are people underestimating the chance of negative outcomes?
Well, close in my interpretation. In my interpretation, which may or may not be right, the initial response to Trump was to price in a lot of good things in terms of less regulation, tax decreases, and the market tended to ignore any of the trade rhetoric and immigration rhetoric that he had in the pricing of assets. So, yeah, other people have different opinions, but in the pricing of assets. That is now diminishing. It is coming out of the market. That diminishment has occurred over the last, let's say, 3 months. I don't believe it's over. As it occurs, yes, we are seeing investors step in and buy insurance. The easiest way to proxy for that, it's not complete, but the easiest way to proxy for that is look at the implied volatilities in markets in options below the market and options above the market. So 90% implied versus 110% implied. And you see those things moving up and down, and they're very, very wide, given the fact that if you look at skew or kurtosis at higher levels of the higher moments of the distribution, that there is almost no realized downside risk. There's a tremendously high payment, given that that's the case. It is rising now. However, I think it's less due to Trump and more due to geopolitics, particularly associated with Europe, and as well as we look into the Middle East and into South China Sea issues. I think those are primary drivers. U.S., realistically, President can't do as much as we often fear or hope that a president can do. So the answer is yeah, but it's just now beginning to come in. It's greater elsewhere.
Thank you very much. Letzte Chance für Sie, eine Frage zu stellen. Wer möchte noch mal die Hand heben? Ansonsten beantworten wir noch mal die letzte Frage über das iPad. One more question. It's a yes or no question.
Yeah, that's even fewer words. Okay, go.
Do you expect more central banks getting involved in purchases of listed equity?
Not any more than they are now.
Thank you very much, Brian. Thank you for your presentation.
Thank you.
Thank you.
Appreciate it. Thank you.
Ich danke auch Ihnen, dass Sie heute bei uns waren. Ich darf Sie jetzt verabschieden zum Cocktailempfang, gesponsert von AXA Investment Managers. Genießen Sie den Abend, stellen Sie viele Fragen. Brian steht auch noch zur Verfügung. Gerne jetzt beim Cocktailempfang oder anschließend bei der Abendveranstaltung. Die Abendveranstaltung ist zu unserem großen Jubiläum heute eine ganz besondere. Wir haben den Tigerpalast aus Frankfurt vor Ort, die wirklich eine atemberaubende Show liefern werden. Wir haben hervorragende Weine, zum Teil aus 1998 und wie jedes Jahr hier im Hilton hervorragendes Essen. Ich bedanke mich. Die iPads, die Technik können Sie gerne hier im Raum lassen und ich wünsche Ihnen einen schönen Abend und freue mich, Sie morgen früh hier wieder begrüßen zu dürfen. Vielen Dank.